Hey, this is Chris Kirkpatrick, the safe bet money guy, teaching the secrets of the wealthy to the movers and shakers of the world so they can avoid the stock market casino and gamble proof their lives. Now, in this video, I'm going to be talking about one of the favorite things for me to talk about, and that is life insurance as a savings vehicle. Now, I know it says as an investment here, but life insurance is not an investment, and I think that's where most insurance agents get it wrong. And the people who love to hate life insurance, I think they get it wrong because they always compare it to investments. I'm going to clear that topic up for you, and you're going to understand after watching this video far more about this than most life insurance agents actually understand themselves. So if this is something you're contemplating, you need to make sure you go through this video. When I first sit down with people, the first thing I ask them is, don't think about where you want to put your money, i.e., don't think about, do I want to buy mutual funds? Do I want to buy stocks? Do I want to buy life insurance? Do I want to buy an annuity? Right? Because the bottom line is, products will not solve your financial problems. The first thing you need to do is think about, what do you want your money to do for you? Because money is simply a tool, and you need to use money as that tool to leverage your money as a tool it is to get you where you want to go. So these are some questions that I have to ask for you. Do you want tax-deferred growth on your money? I bet you the answer is yes. Would you like to be able to access your money with tax-free distribution? Would you like competitive rates of return on your savings? I think probably the answer there is yes. Would you like to be able to save as much as you want? Unfortunately, there's a lot of vehicles out there that cap how much you're allowed to save, and because of that, your options are pretty limited in a lot of ways. Would you like collateral opportunities, i.e., would you like the ability to have access to loans just because you have a bunch of money saved, right? You can't go to a bank and say, well, I got a bunch of money in my 401k, so can you give me a loan? They won't do that. So that's what I'm talking about with collateral opportunities, and I'm going to get way more into the power of collateral opportunities later. Would you like a safe harbor for your money? Would you like your money to be protected from lawsuits or bankruptcy or whatever? In most places, I can show you how to do that. Would you like no loss provision, meaning you can't lose your money? You're not going to be in a situation like it's 2008 and you're going to lose 50% of your account value. Would you like guaranteed loan options? That ties into the collateralized opportunities on the left column there. Is, would you like to be able to have access to loans on a guaranteed basis? Would you like to be able to pay those loans back with an unstructured nature, with you controlling your loan term payments, right? It's not going to be a bank that's going to be really harassing you every month to make your payment on time, or it's going to hurt your credit score or any of that. Most importantly, I really hammer on this one with people because it's so important. Would you like liquidity, use, and control of your money? Really sit with that one. That is so important because cash is no longer king, because with interest rates as low as they are right now, and I'll get into this later as well, but with interest rates as low as they are, cash is no longer king. However, access to cash is king, because with the volatility of the market, when things go bad, you having access to cash is where you can create real wealth and create true wealth. And that is what I'm talking about. Finally, would you like deductible contributions on your, would you like to be able to deduct any contribution you make? Well, what I'm going to show you today, I can give you all the above. The only one that I cannot give you is deductible contributions. Now, because you can't have your cake and eat it too, you're never going to avoid taxes. But once again, if you think taxes are going up, which if you look at our national debt and you look at the $19 trillion that we have in debt and you look at our annual deficit, that number is just getting bigger and bigger and bigger. If you look at all the unfunded liabilities in our country, this number is really huge, and this is really, really important. So I'm really looking forward to getting into this with you guys. Let's go forward. If this is stuff that's interesting to you, I'm telling you, you're going to want to watch this video until the end. Most people think they either need to keep their money in a bank earning nothing, or they need to take risk, invest in stocks or mutual funds, and give up having liquidity, use, and control of their money. And that's not true. I'm going to tell you right now, life insurance is not an investment. However, life insurance is absolutely the most effective savings vehicle Key there is savings vehicle that you can imagine, not investment, savings. Why? Because when you save inside of a life insurance policy, you create a system to allow yourself to create wealth. I call this system abundance banking. Rather than keep your money in a bank account earning virtually nothing, you can save inside of a life insurance contract and earn 40 times the return of a standard bank account. And not only that, you can get other benefits to go with it. I also want to suggest to you that the stock market is no place for your money either. After all, the real rate of return people have earned in mutual funds since 2000 is less than 1%, according to a Dalbar.com report. So my question to you at this point in time is, why would you put your money anywhere you lose access to it, you take on risk, and you have those sorts of returns? For most people, the answer is, I simply don't know what else to do. So for the rest of this presentation, I'm going to show you how you can avoid the stock market casino, save in a life insurance policy, i.e. your abundance bank, and show you how to create wealth. Now, full disclosure here, I do want to tell you, I sell life insurance. However, that has nothing to do with my opinion on this matter. You see, I used to sell mutual funds, but I stopped selling them because the more I learned about mutual funds, the more I despise them. And by the time this video is over, I think you're going to have a hard time disagreeing with me. And I promise you, I will only be presenting facts and guarantees. I'll also throw in a strategy to show you where you can invest and why it's better than the stock market. So let's look at a comparison of a standard bank account versus your abundance bank. So to start, let's just look at the bank account. Now, the average return inside of a bank account is 0.1%. That's what you get for keeping your money in a money market account. You can have a high return savings account and get up to 0.5% or 0.75%, but you have to have a lot of money sitting in an account to gain those kinds of benefits. So what does that mean? That means that you're losing money to inflation, because if inflation is going up annually at a greater rate than the return you're getting on your money, you're losing purchasing power of your money, which means you're simply going broke slowly. The only benefit that you have in keeping your money in a bank is that you have control and you have safety with that money. Now what I want to do is I want to look at a life insurance policy and kind of show how a life insurance policy works if you structure it properly. And you can see I have it highlighted in blue over there on the right-hand side, how much cash value that you have inside of this policy. Now, before I get into that, I want to give you the specs, because it is life insurance and you do have to qualify for it. So this isn't for everybody in that context, but if you don't qualify for life insurance, you can qualify to use this strategy using a wife, using a son, a daughter, a relative, a business partner, so on and so forth. But this is a 38-year-old male, a non-smoker, healthy. They wanted to save $15,000 per year, so you can see that. And they also wanted to dump $50,000 per year in for the first 2 years. So that was just a strategic thing that we talked about. And really what that meant was he had $50,000 or $100,000 sitting inside of a bank account, which after he understood all this and how this worked, he just wanted to get that money out of that bank account, because why keep it there getting no other benefits and so on and so forth when he could do this? And you're about to understand how it all works, why it all works. And basically, it's paid up after 10 years, meaning we do what's called reduced paid up. It's completely paid up after 10 years. He's got no other liabilities, I should say, no other responsibilities to pay on this. It is 100% paid up. The life insurance has no more expectations, and you could see the $285,000 in cash value after year 10. That's going to grow at a 4% rate, guaranteed the rest of his life. And go ahead and find me another bank account that's paying 0.1% right now that can compete with this. Not only does he get the return, but he has access to be able to have a death benefit if he be, and all these other benefits that go with it. So this is how the life insurance contract works. Next, what I want to do is look at a life insurance contract, this exact life insurance contract, versus how a bank account would work side by side. And here you can see the life insurance contract on the right-hand side and an example of a direct comparison of what performance would look like in a standardized bank account, in a normal money market account or something of that nature, where you're earning 0.1% for rate of return. And the key thing here to look at is in a life insurance contract, if you structure it properly, it's actually, it's insurance, so there's expenses that go into it. However, you don't have to give up access to all your money right away. I mean, like, not to all of it, at least in the context of what most people think. You can see year one over in the box that's highlighted in blue. Just to focus on that part, you have $59,000, almost $60,000. So you lose about $5,000 of liquidity, just north of $5,000 of liquidity of your money. However, you also pick up a $1.75 million death benefit right out of the gate. So that's huge, because most people, at least this person who needed this, actually could use that. He needed that kind of protection. And so that's a nice ancillary benefit. Now, the other thing to think about is if he becomes ill, if he needs access to any money, he's got access to some of that death benefit if he becomes chronically or terminally ill during any year of this contract. And that's the cool part here, is this is a contract, right? So there's no speculation. There's no ifs, ands, or buts about it. It's not what's going to happen in the market, I'm not sure. This is a safe holding tank. That's why we call it a banking alternative. Now, year 5, I have it highlighted in red in both. It's basically where you get close to even. Year 5 is the break-even point from a cash access perspective. You have access to virtually as much cash in year 5 in your life insurance contract as you would in your bank account. But from there forward, you can see that the sky is the limit. You have more death benefit. You have more insurance and protection should anything go wrong in your life from a health perspective. You have not only the same amount of money, but you have all this death benefit that goes with it. And so and on top of that, moving forward, instead of 0.1% return, you actually are going to be getting, after fees and everything for the next couple of years, you're going to be getting in the 2.5% to 3% rate of return after all your fees and everything are taken out. Then it gets even better year 10 and forward, because you can see down here in year 10 on the bank account, you have $253,688. On year 10 in the life insurance contract, you have $276,000. So you're way ahead. You're $23,000 further ahead in the life insurance contract after 10 years. Plus, you have all the death benefit. Plus, you have the accelerated benefit riders if you become chronically or terminally ill. Plus, you have access to all that money the same way you would a bank account, virtually the same way. Now, it can take 72 hours to get your money, but quite frankly, what are you going to need to access $200,000 for in a very short period of time, in less than 72 hours? So that's a really, if you compare the two, that's a pretty clear view. Now, moving forward after year 10, year 11 and beyond, that's where there's no more fees. You can see we did a reduced paid up. The death benefit drops down to $843,000. The cash value then increases by 4%, guaranteed every year, no matter what. That is the guarantee contractually with the life insurance contract. My question to you at this point in time is, why would you ever put your money in a bank account when you have this alternative sitting in front of you? Now, remember, I said earlier, no product is going to solve your financial problems. This is simply a storage tank for your money. You want to keep your money safe. You want to keep liquidity, use, and control of your money. That way, when you find an opportunity to invest in, you can have access to cash to invest in that opportunity, and you get your rate of return out of those opportunities, not out of the holding tank for your money, which is the life insurance contract or the bank account, if you decide that for some reason that still is in your best interest. So as promised, I want to compare a scenario, and I want to show you how you can actually leverage and use your life insurance account as your abundance bank, as your private bank, and show you how paying cash is not king, right? You don't want to pay interest to the banks either, but if I could show you a way you could pay interest to yourself, wouldn't that make a lot more sense, right? So I'm going to show you how this works. So what I want to do is I want to look at real estate as the investment opportunity. And these are basically two options for saving up and buying a real estate property. Option A is you can save in a bank. That's the left column. You could see you could save up your cash in a bank. You can buy your real estate cash or with the down payment for the cash. And you basically take the cash flow then from the real estate investment. We're talking about cash flow investing. Any kind of property, you're going to have a positive cash flow from that investment. And you can take that cash flow from the real estate investment and put it back into the bank account to buy another property or investment. That's how you would use a bank. And so what we're going to do is we're going to go through and look at that example. On the flip side, we're going to take a look at the life insurance contract and what we call your abundance bank once again. And instead of paying cash for a cash flow investment property, you're going to take a loan against your life insurance policy. You're going to use the cash flow earned from your rental property, from your cash flow property. You're going to use that income, that cash flow, to pay back the loan, right? And then what we're going to do is we're going to compare the two scenarios between those two options and compare those two to see which one wins, which one looks best after the 20-year period. Now, you can see here that when a person uses the traditional way of banking and they save their money in a bank and then they pay cash for a property, this doesn't have to be a property, by the way. I'm just using this as an example of any type of investment that's going to be a positive cash flow investment. So real estate just made the most sense because we have access to a program, and it's just something I deal with more frequently than anything else. And when you save that money in a bank account, what happens is after year 3, I just wanted to show taking $75,000 out and buying a rental property. They put in 65 the first 2 years and then 15 for year 3 through 10. And I did that in this example just because I wanted to keep it the same as with a life insurance contract example that I'm showing you. And I just wanted to keep it apples to apples. And you can see here that they paid cash for the house, so there's no liability. They have some taxes and insurance and management fees for property management, but their rental income, that's their net rental income. That's their net profit on this. And I am using an exact example of a specific property in Kansas City, Missouri that we have access to through a program that we have, like I said. Now, you can see if they do this, they've paid, they have the asset, they have the house, it's kicking out the rental income. And what that's going to do is at the end of year 20, after all is said and done, that their initial $250,000 investment over the first 10 years is going to be worth $372,000 after 20 years. A key thing to note, however, is that you also have your rental property paid for, right? So you could sell that for extra cash or just keep taking the positive cash flow as income. You just have to take that as it comes at you and figure out what the best solution or option is for you at that point in time. Because remember, as time goes on, rental incomes will inflate the same way as everything else in the world inflates, and you have to take that into consideration. So if the house did double in value by year 20, let's say it's $150,000 in value, you add that to the $372,000 and you have created that $520,000, we'll say, out of a $250,000 investment. So you put $250 in over your first 10 years and you turn that into $520. That's pretty good. And while I would take putting your money in the bank and doing what I just showed you over investing in stocks any day of the week, I want to show you an example using a properly structured life insurance contract. I've blacked out the personal information on here because it's an exact example. This is a specific example that I've used with a client, and I wanted to show you how this works and how powerful it is. Now, before I do that, let's get into the specs. Let's talk about how this works. I'm using the same exact life insurance specs as I used earlier. It's a 38-year-old male, non-smoker, healthy. And instead of paying cash, what I've done is you could see the same parameters here. Year 3, you take a loan of $75,000 against your abundance bank. Now, what happens then is instead of taking that cash flow and saving in a bank, you take that cash flow and you repay the loan. The reason we take a loan is because when you take a loan, you don't interrupt the compounding of your money, the interest compounding on your money, because you're taking a loan against the value of your money. You're not actually withdrawing the money from your account. And that's something, if you want to learn more about, that's another video. And you can just subscribe to our YouTube channel and make sure you find the video on that. And I'll even try to put a link up here if I can. But make sure you check that out if you're interested in learning more about how that works. And the thing is, cash keeps growing while you pay it back. You can see here under the surrender cash value, the cash surrender value, I should say, it's all highlighted in blue there. I got a box around it in blue just to show you kind of like that's the column to kind of think about. That's the money that you have access to. And as you pay the loan back, you have access to that money for leverage or opportunity or protection to make sure that you're protected. Now, you can see that the loan is paid back in year 14, right? That's a key. The loan is paid back in year 14. You no longer have to put money in after year 10 to this contract. It's completely paid up. You have all the life insurance that you have there, $820,000 starting in year 11, on top of the $265,000 in cash value at year 11. That keeps growing as you pay it back. And by year 20, you have $856,000 in death benefit plus $384,000 in cash value. Now, if you notice, the cash value here is more than the $372,000 that you had with the banking. The key there to notice is that you have now, even though you have an extra, let's say, $12,000 in cash value, you also have an extra $8,400 in cash flow on top of that from year 14 to 20, right? Which means even though that's the case, you still have more cash. You have an extra $55,000, almost $56,000 in cash flow, which if you took that and you put it into the policy, it would into the abundance banking contract into your policy, it would perform even better than the $440,000 total. But it just shows that you have leverage. You can use that extra $8,404 a year from year 14 on. You can use that as a lifestyle increase from a cash flow perspective, or if you want to keep apples to apples with the banking alternative to using your life insurance contract as your banking alternative, you can see it's completely leveraged up, and you have more security, more guarantees, more opportunity, more control, and you have more money. And isn't that what you want? You have more money. And the thing is, on top of that, the rental property is paid for, just as we said in the other example. So in the other example, while you've created $520,000 in wealth, in this example, you've created $590,000 in wealth. On top of that, you have accelerated benefit riders, and you have an extra $500,000 in death benefit almost on top of your cash value. Now, Dave Ramsey says you don't get to keep all $856,000. Well, in the other example, how much life insurance do you have keeping your money in a bank? You don't have any, right? You just don't have any. And that is the key. On top of this, you have accelerated benefit riders where if you become chronically or terminally ill, you have access to that death benefit before you die. And that is massively important, right? That saves you money on other insurances that you may not be able to afford. And while it's not an alternative, it's not a substitute for long-term care, because it can't do everything that long-term care does for you. It is a way that you can have access to extra cash if you can't afford long-term care insurance. Plus, the key things here to think is after you're 10 and beyond is you keep access to your money through loans or withdrawals the whole time, right? That's how you access your money. We coach people how to manage that and manage their policies. The key thing here to note is you have a 4% guarantee on the cash value. Any of the cash value that you have in the contract, you have a 4% guarantee. And so after year 10, when we do a reduce paid up, it means it is completely paid up. You have a 4% guarantee on all the cash value in your policy year 10 and on. That is a 40 times greater return than your average bank account. Think about that. A 40 times greater return than your average bank account. Why would you keep your money in a normal bank account knowing this information? So all On top of this, on top of everything, if it doesn't get any better, it does. All or a portion of the money that you have in this account is protected from lawsuits in most states, unlike your bank account, which is not protected in most situations. So one other point that I feel like I need to express to you as for a benefit and why I chose and love this real estate strategy so very much is that you can depreciate your property, right? So on top of all the cash, just from an X's and O's perspective that you have from this investment, you're not taking on as much risk, I don't believe, in the real estate market as you are in the investment market with the stocks or mutual funds or anything of that nature. However, on top of all of the benefits that you have and security that you have with real estate and the appreciation that real estate has over time on a very predictable basis, you also have the ability to depreciate your property, which gives you tax benefits. And when you get tax deductions, that puts more money into your pocket. So if you were to take that money that you save via tax deductions and depreciating your property, and you were to take that money and save it, or leverage that money into more properties or more investments, more savings, whatever, what have you, that just makes everything even the more better. Remember though, products like mutual funds and stocks and life insurance and annuities are not going to solve your problems, and neither will this strategy, neither will the idea of life insurance as a savings vehicle. However, it is the most efficient holding tank that you're going to be able to find for your money. The key is what do you do that money once you have it safe and growing in the most effective, efficient way possible? And you can see here that if you're looking to have cash flow real estate as part of your investment portfolio, there really is no better way to accomplish purchasing that cash flow real estate than using your abundance bank. If you're wondering where you can buy cash flow real estate that actually cash flows positively in month one, email me because it can happen. I know where I live in Vermont, or where a lot of people I work with in California live, it's virtually impossible to buy cash flow positive real estate month one. Most people have to wait a couple years before they actually have positive cash flow. You don't have to do that. You just have to know where to find the real estate. We have access to it. We have a program. We have a relationship with a guy who is just amazing at doing this, completely trustworthy, and I'd love to introduce you to him. So email me, chris@life180.com about that. Or if you have any other questions, I'd love to get into any of this with you. But I hope I've dispelled some of the myths around this stuff and cleared up why both people are right. They just don't interpret it properly. Dave Ramsey is right. Life insurance is not an investment. However, life insurance people, what they're really trying to say, I think, is life insurance is a better alternative to a bank account. Now, if you do this, I want to make sure that you're aware. Don't just do it with anybody. And I work with people all over the place. You don't have to work with me. Find somebody who knows how to structure a life insurance contract 100% in your best interest. And usually what that means is it means a huge commission cut for the life insurance agent. So make sure you do your due diligence and make sure you find an agent who can set you up properly, and you can go from there. I hope all this information was helpful. I hope it was informative, and I hope it opens your eyes to some different perspectives about how you can use life insurance as a tool for you to accomplish all of your financial goals. Until next time, guys, live abundantly, live efficiently, live Life 180, and please, please, please click below and subscribe to my YouTube channel if you find any of this stuff beneficial. Thanks a lot. God bless.